Hi everyone, this is Jason Bjork of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but I've been getting to know him the last couple months in emails. I found his interview over on the Palisades Radio Network. He's general partner at MJG Capital. Matt Geiger, thank you for joining me.
Hey Jason, thanks for having me on the program. Appreciate the time.
Great. Now, Matt, before I start asking you about commodities, let's talk about your background. How did you come to manage money and focus on commodities?
Sure. Well, I'm still pretty young, Jason, only 24. A little bit of an interesting background, especially for the resource and junior resource space in particular. I grew up in Silicon Valley, very far from mining. Not a lot of people I knew or families I knew were engaged in that. And it was really a backdrop from what we were doing. I did gain interest in it, in kind of the resource sphere in my teens. I liked a lot of aspects of it. I liked the volatility. I liked the cyclicality, and how you could buy low and sell high. I liked the VC model aspect, how, if you're in the earlier stage plays, you could place 10 bets and you only needed to get 2 or 3 of those right to return your whole portfolio 2 or 3 times over. Another aspect that drew me to it was that my peers weren't particularly interested in it or knew much about it at all. But I just kind of knew intuitively that, resources are an increasingly part of our consumption-driven lifestyle. And even the iPhone has 30 plus metals in it, and nobody even knows what they are. And so, yeah,
Great point.
Yeah, those are, some of the things that kind of drew me to the space. I ended up going to the Wharton School at University of Pennsylvania out in Philly. And while I was there, I launched the partnership. Started just with friends and family, didn't have a track record. It was pretty early on. And, the timing was rough. We launched in 2011, right at the top of the cycle, very resource focused. And yeah, we're fully resource focused. The good news is that all partners are in for a 10-year lockup. So we're going to be able to see, the back end of this and profit, even though our capital base has shrunk pretty dramatically over the past 5 years. In the meantime, I also launched a mobile messenger along with 2 others. So I'm co-founder and president there, still active daily, and we've been able to raise $9 million. We're seeing good growth, and it's a busy lifestyle. Sometimes I feel like I'm almost living a double life there. And there's a reason I don't have a family or even a girlfriend for that matter, but really focused. And these are my 2, passions, and just spend a lot of time on each.
Very interesting story. Yeah, I mean, that's a great point there about the technology market. People in San Francisco, Silicon Valley, not the one interviews I've listened to, the people I've interviewed there, not a lot of them are that familiar with the resources required to go into these tablet PCs, these smartphones and things like that. A lot about electric cars. The thing about a lot of these wind and solar technologies that a lot of people don't understand is they require an enormous amount of metal, especially rare earth metals. And, you talked about 2011, that triggered my mind. We did have topping in a lot of commodities, and one of the worst markets to start, violently correcting was the rare earth market, along with the silver price and things like that. So, yeah, I mean, long-term, 10 years, that's really good. You've gotten your investors to commit for that long. Most hedge funds are lucky to get them for 1 or 2 years. I remember, did you see the movie The Big Short?
Oh, absolutely, and read the book. Love Michael Lewis as an author.
Yeah, I read the book, and they actually turned the movie into a funny movie. They added an enormous amount of humor into the movie. The book I read as soon as it came out. But it's just really interesting, though. Some of those hedge fund managers, they bet on the subprime bubble. They were a little early, and they ended up making their investors, hundreds of % return, and they still got sued to take their money out. So it's good you found investors that are more patient, because most of them are not.
Yeah, I mean, we definitely forewent some potential funds just because of that, because naturally that's pretty prohibitive. But yeah, we want very patient money. I think that's the way to actually make it in this very cyclical cycle. And going back to your other point, it's just very interesting, and it's still is tough for me to grasp the concept that VC types and the people I know that are invested in tech in Silicon Valley, they understand binary outcomes very well. They understand optionality, expected value, all of that, but they just have no interest in getting anywhere close to these mining stocks. And Maybe that'll change if commodity prices and precious metal prices go up. But I mean, it's really just two different worlds. So it's interesting to be kind of at the nexus.
Yeah, I'm a value investor, and I look for things cheap. And I mean, man, in technology, other than 3D printing stocks, which are absolutely hated, I knew they were going to eventually have a rally at some point. There's really not any value in most of the markets other than the resource stocks. I mean, these things, yes, they do keep getting cheaper, but the baby is being thrown out with the bathwater here for a lot of these companies. I mean, the market has been pretty indiscriminate in the oil space, in a lot of gold and silver companies. There's some exceptions along there, but there's a lot of quality companies that have been, unfairly punished. Some of them are even still profitable at these levels. They've been able to cut costs and still be able to mine at a profit. Now, obviously, if the paper metals prices keep going lower, that might not be the case because you can't completely cut costs forever at a mine. But it's just really interesting. Now, you've brought up some things in one of the interview I've listened to. You talked about the supply side in the commodity market. When I look at the global economy, I don't see a lot of growth there. But you think that the next commodities bull market is going to be because of the supply side. Can you talk about that?
Sure, absolutely. The concept here is that there's a twinning effect with lower prices, and that would be increased demand to some degree. And there can be other macroeconomic headwinds, of course, but the simple fact is you can now buy 3 barrels of oil for what you could buy 1 just 2 years ago, and that's very real. But in this recovery, when it does occur, and I'm not calling a bottom now, just done with it at this point, and we need to be buying picks that have reduced downside to preserve capital. But in this recovery, I see it being a supply side story, and you're looking across the board. It can be in uranium, gold, platinum group metals. Copper's getting closer to where close to half, if not more than half of global production is underwater. They're all in sustaining capital costs are above the spot price of the commodity, and that something has to give. The companies that are more leveraged with debt, et cetera, will lose their assets, and some lucky ones will gain. But in the process, higher price supply will come offline, and when demand returns, which I believe it will, I know there's some differing opinions, of course, but that will only exacerbate it, and we should see a massive upcycle, when we work through this. And I'm seeing, I'm hoping, as a picker of stocks and, a person who analyzes the commodity stories, that it's an individual recovery for each of these commodities. That's not necessarily going to be the case. It could be highly correlated, but it would make sense for me for the commodities that have been in a longer bear market, say uranium or the precious metals, who kind of started this decline in 2011, for them to move out of this sooner and probably more strongly than some of the commodities that have fallen later in this resource bear cycle, such as oil and natural gas. So we'll see how that ultimately plays out, but that's my hope.
Are you surprised, Matt, that more of these oil producers and more of these miners have not gone bankrupt yet?
Well, I mean, it depends on the particular stories, and in the particular commodities as well. So oil companies, I can focus there, even though, for the record, we don't invest in hydrocarbons for the partnership. There's no oil, natural gas, or coal exposure, but it doesn't mean I don't follow the markets, because it is extremely important for the entire resource sphere. But what you are seeing here is the prices have only fallen, within the past 2 years versus 5, and a lot of those companies were hedged, as we know, and a lot of analysts have spoken about. And those hedges are expiring into 2016. You're having reserves revalued as financials come around in the next quarter or so. So there could be some major happenings there this year. And within the majors, I mean, you're seeing mining majors, you're seeing asset sales across the board, and some major worry and share price declines. We should see some bankruptcies here, but I'm looking more on the junior side and companies to go along with. So I couldn't comment on any specific names.
Yeah, I don't need commenting on specific names, but it's just surprising for me, at least, that these miners and some of the oil companies, I guess it's because the Wall Street banks and some of their investors are already so heavily invested. They figure, I'm in for $1 billion. Why not give them an extra 50 million or 100 million so they can survive another 4 or 5 months? And let's hope, the commodity price or the either the copper price or the oil price turns around. I think a lot of that has happened in the last 6 months to a year. And that's why, a lot of these firms have been able to delay bankruptcy as long as they have.
Sure. Yeah. It's a war of attrition. And, the strength of the 10-year bull market that preceded all of this, is also dictating how long this is drawn out. And, there are a lot of big players heavily invested in these producers and they don't want to give up yet. And that's kind of why supply hasn't come off as quickly as one would expect.
Now, I want to talk about the lithium market. You told me about this in some emails. It was the best performing commodity in 2015, I guess. What do you think are the long-term tailwinds for the lithium market?
Sure. Well, lithium, I would say, is broken down into two components. I mean, it's a quick precursor to that is it's essential in basically all handhelds and, a huge amount of mobile technology and things that are really hot in the world right now and massively being adopted globally. At the same time, last time I checked, I think that was less than 15% of lithium demand is going to those areas. Where the real growth is and where the real story would be the electric vehicles and what we see there, and then hopefully grid storage and energy storage for the massive renewable installations that we're seeing globally. So I'm very confident that on the transportation side, that lithium ion is here to stay, for the next 10 years. And that would be hybrid vehicles, that would be full electric vehicles. And, those are still relatively small parts of the global market, but with the pollution we're seeing globally and the fact that, people are still buying cars at a massive rate, even though it may not, seem that way, at least to the youth. That's going to be where they stay. There is a bit of a battle though for, massive storage for these renewables that are being installed globally at a really increased rate, which is impressive considering that oil has collapsed and it hasn't followed that trajectory. And there are some other competing technologies. It's unclear to me, at least, who will ultimately win out. There's vanadium redox batteries as one example of another area where there could be growth. But we'll see how this story plays out, and it's boding very well, considering the pledges we've seen, particularly from China and India as well, to really go green out of political necessity because their citizens are choking in major cities. So those are the two areas I see growth going forward.
Yeah, and also to add to your point there about China, they have air, water, and soil pollution. I mean, they've been mining these rare earth metals for decades and destroying the environment around the mines. They're not mining responsibly. Otherwise, their costs would be a lot higher to mine those rare earths. So basically, in exchange for their rare earth monopoly and putting the competitors out of business, they've completely destroyed the environment all around their rare earth mines.
Yep, we could see a sea change there, and we were supposed to. But it's been pretty wild how low rare earth prices have fallen, even after that big buildup, in the 2009, 2010, 2011 timeframe. China, is out of political necessity getting more environmentally conscious, but we haven't seen that translated into major supply cuts on the rare earth side and some of the other metals and specialty metals that they mine, graphite being an example.
Yeah, Lynas, which was one of the two larger rare earth companies to get capital along with Molycorp. Lynas, I think, is cash flow positive for the first time because of how cheap the Australian dollar is, not because the rare earth prices are high, like you said, but because they're in a commodity currency country and their currency has fallen so much against the U.S. dollar.
Yeah, Lynas is an interesting name. I've tracked it for some time. We own Molycorp, unfortunately, for a little bit of that period as they march down to basically zero here. I mean, Lynas is a highly leveraged name, and it could really go both ways. They're a little more high risk than what we're looking for the partnership. But if rare earth prices, ticked up 50%, 30, 40% over a couple year period, they could be tremendously profitable and share prices would boom. At the same time, they have a lot of debt to cover, and if prices stay low for a 2+ year time frame, things could get tough there. So we'll see how that plays out. But props to them and their management team for actually getting to production and still being around as an independent company here.
Yeah, I actually bought Molycorp at IPO, and I wrote it up to 600%, and then unfortunately I didn't sell it. I didn't sell it at the right time. I should have, bought puts on the position to hedge it out when it was up there at the top. But, I was busy trying to build Wall Street for Main Street and doing other things. I guess I got caught up in, not focusing as much on my portfolio as I should have. But you invest heavily in prospect generators. You were talking earlier in the interview about investing in juniors. Do you think prospect generators are one of the safest ways to play juniors?
It depends on the actual prospect generator, so I'll start there. But right now, these are completely out of favor. If you want to play higher metal prices through the miners, if you want to play higher metal prices, the best way is through the metal. Investors will also speculate at first in the seniors, and then in a sustained long-term rally, it eventually trickles down to the explorers. But right now, there's no interest at all in these guys. And in some cases, you're looking at companies that are trading below working capital. Their market cap is below their net working capital, which is pretty unbelievable. And to me, that's a low risk opportunity because you can't expect it to fall too far from there. In theory, net working capital should be a floor for these companies. So the model of prospect generators, very quickly, mineral exploration is an extremely risky business. It's very hard to do. And these guys will stake a whole bunch of properties using their geological expertise that they've, hopefully honed through the years. A lot of our investments have very, very seasoned geologists on board. And they'll basically do very early stage work on these properties, package them, and then market it to bigger players to come in and spend their own dollars on it. So the beauty here is that you can do a lot for little. You can get a lot of drills moving and properties explored with minimal dilution. The one negative is that if you do find something, you're not going to be able to keep the whole thing to yourself. But these have proven to be good value preservers over multiple cycles, especially if you can find a good management team. So that's the model very quickly. 3 metrics that I look at to evaluate them, and I just put something up on Seeking Alpha that included a list of roughly 40 names that, aren't recommended by any means, but fall within the prospect generator universe in my eyes. 3 things that I look at specifically. I just mentioned the working cap to market cap ratio. Anything close to 1-to-1 there can be very low risk, and there are multiple companies right now that you can buy that are on that list. The second is the runway. What the runway is the company's working capital minus any obligations they may have, which hopefully they do not have anything too big, and then divided by the monthly burn. So you would hope that and this will basically tell you, in a worst case scenario, when does the company have to raise next? And you'd hope for it to be, well later than 12 months. And in some cases, these companies have enough cash to last for 3 more years without having to dilute themselves. So there's good opportunity there. Another place to look is expected cumulative partner expenditures on their combined properties within the next year. So 2016 expenditures relative to their net enterprise value. And that will basically show you, how much their partners are spending to what the market's valuing them. And in some cases, the partner's spending even more than their entire enterprise value, which is exciting. So there's good opportunities to be had. The ones we own specifically, and these aren't investment recommendations, but they are holdings of the partnership, are Viscount Mining, Solitario Exploration and Royalty, Almadex Minerals, and then Reservoir as well. And those are names that I like for some of the reasons above, but there are a lot of different ways to play and some really enticing opportunities right now.
Yeah, I like the prospect generators. There's some of these that have adapted their model a little bit, so they'll sell the deposit to a larger miner to develop, so they don't have to drastically dilute their shareholders or take on a lot of debt to try and build a mine, but they hang on to a royalty for cash flow. So I kind of like the companies that have those where they have a certain amount of royalties. Hold on, my preference for investing in gold and silver, and I think like one of the safer ways to invest in gold and silver besides actually owning the physical metal for insurance and wealth preservation is the royalty and streaming companies. I prefer those over the senior miners. I think those companies can grow without debt. So you have a situation now with like Franco-Nevada where, Glencore's in trouble with their balance sheet. They're fire selling assets. And here Franco, their cost of equity is pretty cheap compared to other companies. And they just went out and did a $500 million gold stream that they got at a good price from one of Glencore's mines in Chile. So, I mean, there's a lot of opportunities there with the Silver Wheatons, the Franco-Nevadas, the Royal Golds. Sandstorm Gold tends to focus more on juniors. We're seeing Osisko Gold Royalty. I wish there was more of those companies that were doing that, because I think that's the way, instead of, buying a lot of these miners individually, I think it's more diversified to buy a few of these royalty and streaming companies instead of buying the miners outright, where so many different things can go wrong at the mine.
Sure. I mean, some of those names you mentioned are a lot bigger than the ones I was speaking of, but yeah, it's been proven over the past couple decades that these are very capital efficient companies. That's why they'll often trade at higher multiples than kind of pure miners. And there are two classes of companies really in these bleak times: the ones that are trying to survive and potentially selling at low prices, and the ones that are the predators and coming in to take advantage and will have the upper leg in the next up cycle. So some of these royalty companies still have, a good amount of cash on their balance sheet and, are putting it to work slowly but surely.
I agree. Yeah, and the royalty and streaming companies have done a lot of big deals in the last year and a half. So a lot of them are kind of digesting, after Thanksgiving, they've eaten their whole meal and they're kind of don't want to see any food for a while. They've used debt or equity to do big deals, and they kind of need to digest for a while before they do another big deal. And, the mining sector, the gold and silver miners, there's not a lot of capital available. You mentioned earlier about the juniors. There's not a lot of companies out there drilling right now, especially small juniors. Most of the companies that are drilling are like the companies in production that are generating a little bit of free cash flow right now.
Sure. I mean, it's dried up tremendously. Some companies are still drilling in very, very high value places. And, there's an exciting discovery hole, for instance, that Orex had in Mexico. I believe their JV partner there is Canasil, and it was 60 plus meters of over 300 grams per ton silver. We're not an owner of that stock, but both of those stocks jumped on the news, which was exciting. There are investors looking for high quality discoveries, but just the pure quantity of drilling is just plummeted. That said, if you are an explorer, it is a good time to explore. Things are cheap. There's good talent to be had. Gas prices are even low for the diesel that you're using with your drill rigs. So, there are properties to be bought that have had previous exploration that are at fire sale prices that you can then grab and then reinterpret the model and go from there. So there are tremendous opportunities right now.
I want to ask you about the uranium market. I was invested in uranium after the 2009 crash. I bought Denison. It went from $1 to $4 a share. It looked like the bull market in uranium was well underway. And then we had the Fukushima accident with, the earthquake, then the tsunami, then the nuclear reactor problems. I guess there's still a lot of problems there with the nuclear reactor that the Japanese government's not, telling the truth about. What do you think's gonna start a bull market again in uranium and nuclear power?
Well, that's a tough question to ask. I guess the key catalyst is in the elephant in the room would be the Japanese. So, under the assumption that they don't start those reactors, this could take a while. I still think that the rewards are tremendous and that it's completely justified waiting, especially with some of the opportunities you see in the space right now. But, to my knowledge, I think only 2 of the 48 reactors that came offline after Fukushima are back online. And, when that does occur and they do turn those back on, there's going to be a tremendous influx of demand. and prices should jump really quickly. Apparently, the spot market right now is extremely tight, and just small quantities of uranium can move the spot price up a few dollars a piece. So when people do start purchasing, there should be a stampede from the utilities, and that would be kind of the more medium term catalyst. Long term, it seems pretty brain dead, and all that growth is going to come from China and India. India in particular just came out with some really pro-nuclear projections from the government, and Keith Barron in his U308 uranium newsletter covered it fantastically, and I recommend anybody to go check that out. But nuclear demand from India is going to go through the roof, both the building of reactors and then of course for uranium in particular. So if you have the time horizon, there's really no better place to be if you like risk, because this is obviously a very volatile commodity. But when it moves up, and if you own some well-placed miners, you can be in for gains in the hundreds and hundreds of percents.
Yeah, I had gains in the hundreds of percent until Fukushima. I mean, it was just that's what worries me about investing in the sector again, is there's always the possibility of that with a nuclear power reactor. But I think you're definitely right about the catalyst for uranium going forward. I mean, Japan being able to import expensive natural gas and other hydrocarbons, they're looking for alternatives to that, and solar and wind don't necessarily work the best, and they don't work all the time. So that's why they were at using uranium-powered nuclear reactors in the first place. But I think longer term, China is going to have to bring a lot more plants online. They were supposed to bring plants online next couple of years. I don't know, maybe there's delays on those. But decades out, I'd like to see, the liquid fluoride molten salt thorium reactor that actually eats up this used nuclear fuel rods and nuclear weapons, because it would eat that stuff as fuel. And the storage cost would be a lot lower, and it would improve the environmental problems that nuclear waste. I don't know if you've looked into the lifter reactors, but I'm bullish on those in the next couple decades.
Sure. Well, it's a great technology, and I think it's mainly a question of adoption. And right now, all of these reactors to a T are using uranium. Well, not to a T. They're not all using uranium. Traditional uranium fission. I think some are using pebble bed reactors as well. But uranium's the feedstock into everything that's being built right now. And I like the long term. I like the long term story there. It's the only form of baseload power that doesn't emit any CO2. We've seen with Paris and just kind of the global clean energy boom that people are getting really serious worldwide about limiting CO2. And uranium can provide 24/7 electricity. Without any of the worries that you see with solar or wind.
Well, the thorium reactors, Matt, they also have to have uranium too, but that's not, they have to have thorium and uranium, or plutonium and thorium.
I see.
So yeah. So they eat the stuff for the thorium to become fissionable. It has to be exposed to either plutonium or uranium. So a certain type of uranium. So it's recycle. That's why I like that reactor particularly. It actually recycles.
Sure. Well, I mean, it looks like the Chinese are really leading this next wave of investment. Obviously, even the U.S. consumes a massive amount of uranium, and 20% of our electricity virtually comes from nuclear plants, which is a pretty high number. But China is building everything right now, and India might follow suit. So we'll have to look to see what technology they're using going forward here.
I have a question now, since you manage money. It's about managing your risk and diversification and things like that. Now, obviously, you want to concentrate your portfolio somewhat to get good returns, but how do you protect your downside in your investments and in your money managing portfolio, and maybe in your personal portfolio? Do you keep extra cash? Do you use options for hedging? What tools do you use?
Sure. Well, we could always do it better, and this particular bear market has been extremely, extremely rough. And there are lessons learned across the board, I think, for all investors. It's been long and steep. Some things I've learned from it, and I'm going to use looking forward. really just pay attention to how much enterprise value a certain company has. That just going back to that working capital to market cap. It's very back of the envelope, very basic, but looking for companies with no debt, particularly in a down cycle, is really important. As far as diversification, I mean, it depends on the actual investor and what you're trying to accomplish. So I would never advise any investor to go all in on anything. But as we're a partnership and we have pieces of a bunch of different people's portfolios, we can take a very concentrated bet, and so that's why we're fully resource focused. Some things that people aren't owning right now that could be interesting are precious metals, and I know you talk a lot about that on the show, but there's tremendous room here for investors to kind of move into that as well.
Yeah, I think we've basically hit close to a bottom. Maybe we'll retest some support levels for gold and silver, but it looks to me like we've gotten a lot of money, managed money that was on Wall Street and other countries start to move into gold and silver. Maybe they were in gold and silver prior to 2011, 2012, and they sold out around then, and they swore off gold and silver for a long time. But they seem to be coming back in because the more the general stock market falls, it seems the higher gold and silver price start to creep up.
Sure. Yeah, absolutely. We're seeing crazy rallies just over the past 2 weeks in kind of the precious space. We'll see if that continues. It could be a good way to lead mining stocks out of this terrible period here. But as far as the actual bets that I'm placing, I'm assuming that we're going to see lower prices for 12 to 24 months, and if there's a surprise to the upside, then great. If not, let's try to preserve as much capital as we have through this period, and then we'll do extremely well in the upcycle. There's no doubt about that.
And you think that these Keynesian central bankers in Japan and Europe and the Federal Reserve, even some of the Federal Reserve members are talking about it by putting out trial balloons? Do you think negative interest rates are going to be good for gold and silver then?
I mean, it has to be. It doesn't make any sense to invest in Japanese bonds that are trading in negative territory. It's unbelievable. Why would you not put that into gold? So I think that's a catalyst. It's starting to get headline news. We might have seen the U.S. dollar roll over here. It's definitely been down over the past couple of weeks, but we don't really know at this point what's going to happen. But it will at some point because it's been a massive sustained rally. Tons of money locked up into U.S. Treasuries with very low rates, and I think it makes sense to go into something hard right now in this world full of paper.
Exactly. And I think there's going to be, like you said earlier in the interview, supply side problems in gold and silver, especially silver, because, so much of it is used by industry and not a lot of it is recycled. Only a couple 100 million ounces a year are recycled out of the massive amounts of silver that are produced. And a lot of these mining companies, they haven't replaced reserves. So they've been cutting costs to the bone just to survive, just to buy themselves time, hoping the price will rise again. So it's something that this is unsustainable. That's my point. And I see that, in the oil market's unsustainable. We're going to have bankruptcies, a lot of them, probably some larger firms in the next couple months. In the oil market, we're going to have, gold and silver at bottom, maybe there's not going to be as many bankruptcies. But in order for these companies to start spending more money on exploration, bringing on new mines, the price is going to have to go higher, and it's going to have to stay there for the companies to take the risk.
Yep, absolutely.
Great. Well, I enjoyed our conversation today, Matt. Please tell our listeners where they can find your work or if they're interested in signing up for your fund.
Oh, sure. Well, I just put out a new semi-annual report. I put out an investor letter, pretty lengthy, just detailing thoughts on the general market, performance, portfolio allocation, and then a new featured investment, which is one of our holdings, and then I'll update on some past feature investments as well. So that can be found at www.mjgcapital.com, and just click on the investor letter section, January 2016, and it's all there. I can be contacted through the website as well. So happy to talk through any of this. Absolutely love the space, and there's some potential excitement here, but I wouldn't change the investment strategy. Got to stay smart and conservative for the time being. But yeah, would be happy to talk to anybody about the partnership or thoughts on the market, etc. Thank you for the time today, Jason. This was a fun talk, and I listen to your podcast frequently.
Well, thank you for your time. I enjoyed speaking to you, and hopefully we can have you on in the future and talk about investing in different commodity sectors. As a contrarian and a value investor, I am looking for growth, but I'm greedy. I'm greedy when others are fearful. I'm looking for cheap, undervalued growth where I can the market's not going to expect things. And then, when sentiment changes, when expectation levels change, that's when things get re-rated.
Sure, and you'd have to hope that other contrarians, with the non-traditional mining background start moving into the space as well, because for some of the companies with a lot of cash, they're high dividend yields. They're, just massive opportunities to be had across the space if you buy companies with low debt that can really profit in this, through this period and then into the next upcycle.
Exactly, and I think you just mentioned a lot of the reasons why I prefer the royalty and streaming companies the most is I don't think any of them are going to go bankrupt. I think they're going to survive the cycle. Maybe in the case like Royal Gold, they had one of their deals go bad with Rubicon Minerals, $75 million deal that goes bad. The market punishes them a couple $100 million in market cap. That's a value there because they only lost $75 million in the deal. The company still has a lot of cash flow. They're going to survive one bad deal going bad.
Yeah, no, absolutely.